I'll say that over the past few weeks, there's been a very high number of days that have turned out to be super small range days or dojis that make it very difficult to make any money on any kind of trading. And so everyone's looking for answers, right? So people come to me, what can we do about this strategy, Ernie? That out of the money butterfly is tough in these kind of environments. Fortunately, this type of market action only happens about 30% of the time. And typically these type of trades also have these nice long tails on them, so there is still an opportunity to profit. The thing is with the SPX, that range is limited. So the strategy really isn't to go after a different type of option play. I mean, that's just not the way to go. The right thing to do is to stick with the same strategy, same type of option, the out of the money butterfly, super wide, whether it's a single fly or a double fly, what we call the Batman. The answer to this is to find something that has way more volatility, something that will get you into that profit zone on a more regular basis, something that has a lot more flexibility to it. Now, with that comes some caveat. Now, what I'm talking about is the NDX, the NASDAQ 100, the index on the NASDAQ 100. I believe that covers the 100. It may be the 1000, but I'm not sure. I think it's the 100. It's essentially the same thing, or the index version of the futures NQ. And of course, we use the NQ as a way to analyze the NDX because with the NQ, it has volume, and then we can use volume profile to create our market structure that we use in our profit taking. Now, the NDX compared to the SPX, there are quite a few similarities. They're both indexes. They both have 0 DTE events 5 days a week. So Monday through Friday, just like the SPX, you can trade the NDX. The NDX has another really remarkable feature compared to the SPX, and that is that it's about 3 times the size of it. So that means that you can put on spreads that are much, much larger for an equivalent amount of movement in the market. Now, on top of that, besides that, the NDX tends to, as a percentage of overall movement, tends to move much greater or be much more volatile than the SPX. So in a given day, not only is it wider, when I say wider, when we put on a fly, you put on a fly based on the width of that fly. On an SPX, let's say that a move on the SPX might be 30 points. On the same NDX, it might be 120 points. The NDX is already 3 times bigger, so you would think that, okay, then it should move 3 times as much as 30 or 90 points, but it doesn't. It moves another 25, 30, 40% more. So not only is it bigger in terms of just sheer numbers, the current SPX is sitting around an index of 4,000 something, 4,400, and the NDX is sitting around 13,300. So it is literally 3 times larger. So when you put on spreads there, they can be much, much bigger. So what does that mean to you? When you put on a 30 wide spread, and let's say that you're using the 10% rule for your debit, that means that a 30 wide spread with a $3 debit has a 1 to 9 risk to reward. That's because when you take the maximum profit available on a 30 wide spread, that would be 30 minus the $3, that's 27. Take the debit, which is your risk, divide it into that 27, and you get 9. So what you're getting is a 1 to 9 risk to reward ratio. That's pretty much the smallest risk to reward that we go for. Typically, we'll go for something much larger, 1 to 14, 1 to 18. And with the NDX, it allows us to do that. Now, on the SPX, a 30 wide spread is a good size spread, and that's the kind of move that you're hoping for in a typical day. These days, we're getting much smaller moves, so we have to still play our strategy, except that we're not getting the kind of action that we really want. And particularly when you put on a Batman trade, it never gets far enough, and sometimes we'll end up right in the middle and cause a loss. So in comes the NDX. It moves more, and you can make the spreads much wider in the given amount of travel in a particular day. So with the NDX, instead of relying on, say, a 30 wide as our max trade, we could be looking at 40, 50, 60 wide. Now, 60 wide trade is going to have a max potential profit of $5,400. That's 60 or 6,000 minus 10% or 600. That would be 5,400. So then, of course, 600 into 5,400, that gives you that 1 to 9. Now, typically, we don't put on a trade like that for $6. And that might be above and beyond the capability of somebody with a smaller account. But you could put it on for $2 or $3, and now you have a risk to reward of 1 to 18 to 1 to 20. Now you're really making efficient use of your capital. And when you have a spread that wide, the profit potential early on is tremendous. So you could be taking advantage of a trade like this early on in the day. Price tends to move early in the market session, in that morning session. A lot of times you can get out of an NDX trade with several $1,000s of profit with just a couple $100s down. Now, I'm not saying that this happens all the time, but that potential certainly does not ever happen with the SPX. You typically have to wait until later in the day in order to come anywhere close to that kind of profit-making potential for the same money. Now, what is the caveat? There's always a catch. There's always a catch. And the catch here really is the liquidity and the volume that's in the NDX. Now, is that really a big problem? Not always. It can be, but it's really for those people who are not really used to trading the NDX. If you're used to trading the NDX, then it's not so big of a deal. A lot of people look at the volume and the spread and they get scared. They look at that and they say, how am I ever going to get a fill? And so they don't even try. Now, what I've found is that there always seems to be a counterparty there willing to take your fill regardless of the volume. And the volume is, it's sparse. Typically within 10 or 15 strikes, you're only going to see 100 to 200 contracts on each strike level, where on the SPX, you're going to see 2 or 3,000 or more, maybe as much as 5 or 7,000. So you would look at that and you think, well, am I going to get filled? But it's surprising just how often and how easy it is to get filled. And if you don't get your price right away, it's just a matter of cancel and replace, maybe as much as 10 cents, 25 cents, 30 cents tops. But now you're going, if you look at this in perspective, you're going for a much bigger piece of the pie. And so when you have to cancel and replace for that relatively small amount, you're going for way bigger. So the scale is not there. It's like having to only cancel and replace or change your bid by 5 or 10 cents on the SPX when you have to cancel or replace 30 or 50 cents on the NDX. So while in absolute numbers, it seems to be much bigger and a bigger hassle than the SPX, in reality, it's easier to get filled and the potential is so much greater and you're not risking really any more money.